So today I'm going to run you through an example of how we financed one of our recent deals. Hey guys, welcome back to our channel. Max and Patrick's not here today. This is my topic. I'm going to run you through financing and understanding carrying costs when it comes to fix and flip properties. Understanding financing and carrying costs starts actually right at the beginning of the purchase and or identifying the right property. Especially in a competitive market like Arizona, you gotta be ready to pull the trigger when a good deal comes by. And with that being said, just to make an example, if we're talking about a purchase price of $500,000, the question is, how are you purchasing this property? Are you purchasing it outright, full cash? Are you doing a conventional loan? Are you doing a construction loan? Are you using hard money, which is probably one of the most typical resources of developers and investors out there to do fix and flips? And hard money is typically, in today's market, the rates are anywhere between 10 to 15%. There is extra costs involved, not only the interest payment that are due on a monthly basis, but also loan origination fees, doc fees. There's plenty of costs that some hard money lenders have laid out very transparently. Others we find there's some components that you don't get to see right away. You get hooked by a fairly low interest rate, but then with loan origination costs, doc fees, legal fees, and additional fees, it adds up pretty quickly. So understanding what your carrying cost is truly starts by identifying what is the source of financing. The way Patrick and I do it is we have established relationships with private investors, with local banks, as well as local mortgage companies. So today I'm going to run you through an example of how we financed one of our recent deals. The purchase price was $1 million just to even up the number. We took out an acquisition loan of 60%. That means $600,000 was lent to us by one of the local banks that we have a standing relationship with. Typically, clients, developers, investors that we represent as agents on the brokerage side leverage about anywhere from 75 to 90%. But that number does not go off solely the purchase price, but off the entire project cost. So we have the purchase price, there's construction costs, and then there's additional holding expenses that I'm gonna go and dive into here in a little bit. But going back to where we just were left off. So $600,000 is a loan by a local bank. At that time when we closed the deal, it was prime +1 and prime 4.75%. So we're talking about a 5.75% interest rate on the amount that we lent from the bank. The loan origination fee is 1.5 points, that is the correct term, and it's $9,000 equivalent. So that is pretty much the cost that we had to acquire the property, as well as ongoing interest costs. 12 months term with an extension option. Depending on whether it's a private investor, a hard money lender, a bank or mortgage, those terms may vary. There's some resources or some financing institutions that will charge you an extension fee, and again, those are the fees you have to look out for before you make the decision. It is very crucial to understand what are all the financial components that come into play when undertaking such a project, and that, like I said, starts right at the beginning. So now we talked about the financing components up on the purchase, as well as some of the holding expenses that are incurred while doing the project. Now that means we need to come to the closing table with about $409,000, as well as additional fees for escrow and title. That's going to enable us to close on the property. Now, depending on whether this is an acquisition loan or a construction loan, to just point out two of those examples, there is additional construction financing that is granted by the lending institution, which in that case, the total financing of the project includes the purchase as well as the construction cost. In that case of that project, there was no construction cost financing because we financed everything in-house, as in it was available cash to us. that we had raised prior to the start of the project. Another thing I can only urge everyone who is trying to get into the business, trying to do their first flip, is also making sure that all the money that is required to do the project is available. What we do see a lot here is that maybe if the project total requirement is $800,000, that you get the first $400,000 plus the points and the closing expenses, and then along the way when you do the project you think you will raise the money, or other people made a verbal commitment to give you the funding to do the construction. We've seen those have been a lot of headaches on our client side. One of the reasons why we decided to make sure that you have the money right off the start to be safe, have it tucked away and allocated specifically for the project. Any loans, whether it's from a private investor, a local bank, a mortgage company, or any other financial institution, include typically personal guarantees. What that means is, upon closing, you will be signing that you are guaranteeing that loan. The lender is in first position. That means if there's any default, any payments not made, or any scenario, they have the asset as a collateral, and on top of that, you are personally guaranteeing. Typically, when we see a property gets acquired for $1 million and the bank lends, in this example, 60% of the acquisition cost, even when the market changes, and especially when improvements are done along the way to the property, the bank is in a very, very safe position in being first. That means they're entitled in first position in case something happens. Now you guys are already realizing there's many different ways to structure this, and to find your sweet spot and to understand what works best for your business takes time. Patrick and myself have done north of 20 projects by now, and with no leverage, then learn to understand that leverage is something that will give you an extra upside on your cash investments. We realize that hard money is a very convenient resource of financing, but comes with its price. So the cost of capital is fairly expensive. Paying 12% on your loan, you quickly realize that every day counts, and that any kind of delays, whether it's in the construction part or in the resale part, will be heavily impacting your profit. And it's going to eat into your profit, and one of the reasons why you want to make sure that you build a good product, price it accordingly, and sell it as quickly as possible to maximize your profits. Now, on top of the financing, whether it's a loan or any kind of form of debt financing that you choose from, on top of that we have the holding expenses. And we've seen several times that those have been underestimated, including by ourselves in the beginning. So holding expenses are one of the main topics that I wanted to talk to you guys today about. So when it comes to holding expenses, we have fixed expenses as well as variable expenses. We started talking about the interest expense that is typically a fixed rate that is paid, but somewhat variable as well, because the total cost of the interest is determined by the length of the project. So the faster you sell, the less interest you pay, the more money in your pocket. And we talked about pre-selling in one of our previous episodes, where you get an understanding of what needs to be in place and what needs to be done in order to sell the house as quickly as possible to maximize your profits. So when it comes to holding expenses, make sure you have a list of all line items that are going to be part of the project, and they don't really change. The item stays the same, just depends on the type of financing, the length of the project, as well as the total cost of construction, how much that's going to vary. I'm going to pick out a couple of those main line items when it comes to holding expenses that are a big cost driver and are the ones that you need to pay the attention to the most. So obviously we have the total construction budget. We typically recommend that you have a budget and you include a contingency. Make sure that you have accounted for material and labor, include a contingency in there, and especially for everyone who's looking to do remodel, If it's a cosmetic remodel that doesn't involve any structural changes or any additions, the scope or the budget scope is a little bit more forecastable. Whenever you start adding square footage, taking off the roof and doing anything structural, there's a lot of moving parts that sometimes cannot be determined completely before you start the project. So make sure you account for those potential variables when you start the project, and actually prior to that when you start running the numbers on your project. So we have soft costs. Depending on if you need to work with an architect, there's going to be extra costs that are incurred for schematic designs, for mechanical, structural, engineering. All those are so-called soft costs that need to be accounted for as well. And that obviously comes with a timeline. You know, those projects that are a larger scale like our projects, you have to consider that there's going to be extra time and extra money for the structural and architectural components of the project. The next one on the list is the insurance. There is the existing dwelling insurance that we talked about, the remodel, as well as the builder's risk policy. That means that you have the existing dwelling protected if anything happens, and on top of that, once you start remodeling, there's going to be a policy in place that ensures the actual build out of the remodel. The general contractor has insurance that he carries for himself, which is a general liability insurance, and protects him and his workmanship. Depending on whether you are in a homeowners association or not, there's additional fees that can come, which are either monthly, quarterly, or yearly dues to be part of that association. Something important to consider: typically you have design as well as architectural guidelines that need to be considered when it comes to doing any type of remodeling inside of the community, which obviously will add to the timeline of the project, as there will be approvals necessary to do the work within the guidelines of the HOA. On top of that, we have utilities, water, electricity, gas, depending on what's available. If there's a pool in place, there's pool maintenance. And again, those items might sound like they're not a lot, but they add up. You want to make sure that you accounted for those items when it comes to making sure that the numbers work for your deal. Then last but not least, towards the end, two things that are very important. One is property marketing. There will be some cost to market the property depending on whether it's your project or not, or which structure you choose to do your deal under. You will have to incur those costs within your project. If you hire a real estate agent, those costs are typically absorbed by the agent. And I talk about renderings, pictures, videos, any kind of online, offline advertising. One of the advantages of having a real estate license, which we talked about in one of our earlier episodes, is that you're able to retain 3% commission on the front end if you purchase through the regular multi-listing service, and you can save 3% on the back end, as you don't have to pay an agent to list your property. If you're not a licensed agent, you need to make sure that you account for the costs on the back end. As you can see, this is a topic that's not very exciting, but it's where the money is, and you got to make sure that you run your numbers right. And I guess the last big piece on this is making sure you understand the comparative market analysis, that you buy at the right number because you make your money on the buy, as well as understand that up on the resale that you run a sensitivity analysis. What I mean with that is the numbers need to work even at the lowest resale price possible that you can account for with the local comps. You should have a base, which is a low, a medium, and a high. And if the numbers work at the base with all contingencies and all numbers that I mentioned, then you can move forward and decide to do the project. And if you guys have any questions, let me know. Good luck doing your project, and thanks for tuning in. Don't forget to subscribe, like, comment, and see you on the next episode.